Welcome back to AC Spencer Trades, and today we're going over managing capital. So once you've got a strategy that works and you've proven that it works in demo, now you need to start thinking about how you're going to trade this in the live market, how you're going to attack those live markets, and which phase you would like to go for, or whether you would like to go for both. There's two main ways of growing and trading live accounts, and of course prop firms as well. So today we're going to cover exactly how I would trade it, and then you can use that information to decide whether you would like to trade how I trade, or whether you would like to cowboy it and do it in another manner. So the two phases really come down to how much capital you've got, your appetite to risk, when you're taking profit, sizing up, sizing down, and the ability to be able to trade it with prop firms. So prop firms kind of come under their own category. So we're going to cover that right at the end, because you can use both of these phases in prop firms, but it comes in a slightly different fashion. So make sure you hang around to the end if you want to be able to trade prop firms and do it in a profitable manner. So with the starting capital in the standard phase, this wants to be anywhere from 10 to 20% of your net worth, okay? You don't want to be putting 100% of your net worth in there. You don't want to be refinancing your house. You want to put something in there that you're comfortable leaving for a long duration of time. So if you go and put 75% of your net worth into your trading account, the chances are you're going to have to start taking profit, and this is going to have a detrimental effect to the compound of the account over a long period of time. Now, the risk size when you're trading in a standard fashion is going to be between 1 to 2% of your account balance, okay? You don't want to be risking crazy amounts of money. You want to be able to suffer through drawdown periods, be able to survive them, and not have to size down if you go through these drawdown periods, because this will completely skew what your results look like over a long period of time if you start over risking. For me, it's the 1%, right? I don't want to be risking any more than 1% on any trade. I like to stick with a fixed risk on all of my trading positions. I don't really believe in A, B, and C trade setups. I feel you should only be taking A+ setups, right? Because that should be your strategy that you're trading. Of course, you're going to have playbooks and strategies which have higher win rates, higher risk to rewards than others, but for a data perspective, keeping everything to that 1 to 2% just keeps the data really clean and allows you to generate a good data pool without any skews being driven by the size of your risk. Now, taking profit. This is massive. In this standard phase, you don't want to be taking profit for as long as possible. So you want to ideally have another source of income, right? Unless you're dealing with a very big starting capital. So whether that be a 9 to 5, whether that be a side hustle, whether you've got a business, whatever it is, I recommend you keep that whilst you're trading through this standard phase. Trading doesn't require a huge amount of man hours, right? You can be a day trader with 8 hours a day. You can be a swing trader with 2 to 3 hours a day. If you want to scalp, then standard phase is going to be a little bit more difficult, and that's going to be a full-time career, and your risk is going to be between 0.5 to 1% if you're scalping. So taking profit, there's not a strict place where you have to or you cannot take profit, but the longer you hold, the better your compound is going to be. And of course, that is going to create bigger and bigger and bigger returns over a long period of time. So I would say, realistically, you want to be going for 5+ years before you start taking a profit out of a standard phase account. Now, we've got the growth phase, which we're going to come on to shortly, which is going to allow you to generate an income whilst this is building in the background. So this is the key to being able to make trading a full-time career as fast as possible. And of course, the good old prop firms gives us another route for that as well. So make sure you stick around, because those two are going to be where you start seeing this come into a realistic job within 12 to 24 months of starting your trading career. Now, sizing up, you have to have boundaries on when you size up and when you size down. You can't just have these random. You can't just go, oh, I feel like I want to size up now. Oh, I want to feel like I size down, right? People do this when they go on winning streaks and losing streaks, and that is not an analytical way of sizing up and sizing down. For me, what I like to do is I stick to the 10% rule. If my account balance goes up by 10%, then I size up. If my account balance goes down by 10%, then I size down, and there's no in between. And this just keeps having everything really strict and data driven rather than going on emotions and how you feel and what you think of the market. Because if you think the market is good right now, the market is gonna humble you, right? So having these strict parameters is really simple. So say we're on a 100K account, right? And then we go up to 110K. Now, this is the point where I size up, and I will not size down now until I go back to my 100K, and then at that point I go back to risking just 1,000 instead of 1,100. So we go up by 10% once we hit this 10% limit. So that is my threshold for sizing up and sizing down when I'm trading in the standard phase. Now, moving on to the growth phase, this is going to be where you can start to generate an income. So with the growth plan, right, this is a completely different style of trading to the standard phase. You're going to grow capital much quicker, but you're going to be exposed to losing your whole account, right? So with starting capital for this, I recommend between 1 to 5% of your net worth, because the chances are you're probably going to go between 3 to 5 cycles before you generate a really, really nice solid income that can then feed into your standard phase. So what you're going to do for this, for your risk size, you're not going to be using a percentage of your account. You're going to be using a fixed risk. And this should be between 10 to 25% of your account balance, which seems absolutely crazy, right? And this is why we're only risking 1 to 5%. It's not even your full net worth. This should be really 1 to 5% of what you earn on a monthly basis so that you can keep cycling this, because you can run these accounts up to ridiculous numbers in quite a short period of time, and it can get pretty serious pretty quickly. So with this, 10 to 25% of your 1 to 5% of your monthly income can be placed on each trade. Now, with this, you don't want to just keep scaling and scaling and scaling and scaling and scaling. When I look to size up for this is when I do 100% of my account balance, okay? Now, this again seems wild, right? But I promise you, if you actually attack this with structure, you can do really, really well. If you're risking 10%, you can have 10 losing streaks before your account goes boom, right? And when I say 10 to 25%, I mean this does not change from your initial deposit into the account. So if you're risking 25% and you lose the first trade, you're risking the same amount on the next 3 trades until you blow up. As you did on the very first one. So this is a all or nothing way of trading, and honestly it can get really extreme really quickly and feeds, like I said, into the standard phase of your account. So sizing down, there is no sizing down. If the account goes boom, the account goes boom. And this is why you have to be really strict on how much money you put into this account, because the risk is so much higher. But the reward, of course, is much higher off it as well. For me, I stick to the 10%. I don't want to be going past that 10%. And then in terms of taking profit, what I like to do is run the account up to 100%, and then I will remove 50% from that account. We're now completely risk-free. Everything that is inside of that account is profit which has been generated, and you have taken this 1 to 5% back out of the account. So you've got 0 risk on the table. The only thing you're risking is the time that you've spent. But the time that you've spent, you're running this standard phase and this growth phase together. You've got 2 separate accounts. So whether you just did this or whether you did both, it's the same amount of time spent in the markets, right? So you may as well add a growth phase into your 2 trading accounts so that you've got the possibility for the massive upside. And realistically, the standard phase should pay for the growth phase with the profits that you make from here. Okay, so you're not actually risking any extra capital, but this is going to be where all the money is made, and you do not stay doing this forever. There is a limit for how far that you should take this. So I say no more than 1000%. If you get to 1000%, you end it and you start again if you want to start again. Personally, I think you just cycle that money into your standard phase account and you just keep recycling, right? You 1000% in, 1000% in. And then the growth of your standard phase account becomes absolutely astronomical because you're rinsing the profits from your growth phase back into the standard account. And that is where the big long-term money is made. And this is going to allow you to start taking profits sooner. I don't like to touch profits from this growth phase. I like to touch profits from my prop firm. So that is the last thing which we're going to go over. So give me a minute to clean this whiteboard and I'll be right back. So with the prop firms, again, you've got 2 ways of trading this. You've either got the ROI game or you've got the beginner game. So the plan for everyone is to come into the ROI game, right? But first of all, you need to prove to yourself that you can trade prop firms, stick to the rules, and get that first payout. Once you've got that first payout, the psychology behind everything comes much, much easier. So when you're first starting to trade prop firms, the whole purpose of it is to get that first payout, because this just proves to you that trading is real and that you can actually generate a profit from it. So in the evaluation phase, you're going to be risking between 0.5 to 1% of your account, okay? Because you don't want to mess around doing this, 0.25 to 0.5, because it's going to take you months to pass the account, and that can also mess with your psychology. So the sweet spot is between 0.5 and 1%. This gives you enough tolerance that you might blow up 1 or 2 accounts, but you're very likely to get your account passed if you've got a profitable strategy and you know that the data tells you that you're not going to have too many losers in a row, okay? Now, of course, this is going to happen at some point. It doesn't matter which phase you're in, and then you're into buying new accounts and starting again. But once you've passed the evaluation, your sole focus is to keep hold of that account without losing it. If you lose it, now you've got to waste months again trying to pass this frickin' eval stage, and it becomes incredibly frustrating. So you want to keep hold of it, and you do that by risking minimal amounts. If you need more capital to trade, you need a bigger evaluation. Do not just start risking more money. I say this with aggression because I've seen it so many times. People are like, woohoo, we've passed the eval stage. And then they start risking fucking 5% on each trade and it's gone before they even reach their first payout. Do not do that until you're comfortable. And even then, you can see that my risk per trade, even on the ROI game, is still 0.5% plus. So that leads me on to the ROI game. With this, return on investment, that's what ROI stands for. You're now at a point where you've generated an income from your previous account, so you've got a monthly income now from this one. Now you can use that to churn a lot of evaluation accounts, right? So the purpose of this is to get the account passed as quick as possible and then keep it. Okay, so you might go through 3 or 4 evaluation phases, risking 2% plus, but that is more valuable to you at this point because once you've got the account passed, it's not going to take you long to earn that money back with 0.5% plus risk. So this just becomes a purely ROI game. You pay $40 for the account, you lose 4 of them, so now you're into a little bit of debt. But you can earn that back within 1 to 2 months, right? Which is still much faster than going over the beginner game. So this is how you trade with prop firms, either as a beginner Or once you've completed that beginner phase, you go into the ROI game, and that's where the real profits start to churn in, because that's what prop firms are at the end of the day. You have multiple prop firms, you have trade copying systems, and this allows you to capitalize on those prop firms in a very big fashion. Okay guys, I hope you've enjoyed the video today. Please leave a like, a comment and subscribe, and I will see you in the next one.